Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Jeremy Zook, lead China sovereign analyst at Fitch Ratings. In today's episode, we'll take a deep dive into China's banking sector, looking into some of the trends and challenges facing Chinese banks at the moment, as the macroeconomy continues to deal with an ongoing property sector adjustment, high debt burdens among local governments and LGFVs, and deflationary pressures stemming from subdued domestic demand. Not only do banks have to manage these challenging developments, but they are also being leaned on to play a larger role in the policy response. Fitch's banking team has done quite a bit of research on these issues in 2024, so we thought it would be useful to explore some of these topics in more detail. Joining me today to talk about these issues is Elaine Xu. Elaine is a director in the Financial Institutions Group at Fitch Ratings based in Shanghai and has been with the firm since early 2018. She conducts ratings of major Chinese banks and other financial institutions and publishes periodic research on emerging developments and risks in China's financial markets. Elaine has over 10 years' work experience in financial institutions research, both domestically and overseas. And before joining Fitch, she worked at both equity research and private equity firms with a focus on banking and related sectors. Elaine, it's great to have you here today.
Hi, Jeremy. Thanks for having me today.
So to start out the conversation, I thought it would be helpful to just get an overview of the current state of play in China's banking sector. As I mentioned, China remains in the midst of an economic slowdown, driven by the large ongoing property sector correction and high levels of leverage in the economy. How are these developments impacting banks? And I guess in particular, what trends are we seeing around profitability, asset quality, capitalization, and credit growth?
Right. China's economic growth slowdown has dampened the performance for Chinese banking sector. For Fitch-rated banks, they saw their revenue declined by 3% on average year-on-year during the first half of this year, mostly due to the net interest margin contraction. Having that said, net profits were largely flat thanks to a reduced impairment cost because there is some ease on new NPL formation during first half. We expect loan growth of 9 to 10% this year, which is slower than the growth last year because of a weak demand for residential mortgage, also for loans related to property sector. Consumer sentiment also remained quite weak, with retail sales growing only slightly above 2% in August year-on-year, which also weighs on consumer type of lending, such as credit cards and consumer loans. You can see a sector-wide net interest margin further contracted to 1.5% during first half, comparing to a 1.7% last year. A combination of factors drive this: multiple times of LPR reduction, which is the benchmark rate in China, mortgage repricing, and other policy mandates targeted to lower the overall borrowing cost and also support the economic growth. There has been some quarter-on-quarter stabilization in net interest margin thanks to reduction in RRR, also deposit rate cuts, but it may be too early to say the margin has bottomed. Now, the good point is capitalization for our rated banks has remained stable despite of the profit pressure, partly due to the adoption of the new capital rules this year, which lowered the risk weight for some asset class. The system non-performing loan ratio was flat as banks continue to resolve large amount of non-performing loans, with NPL resolved during 2018 to 2023 amounted to 16.5 trillion, which is equivalent to around 7% of the system loan. So despite the near-term profitability and asset quality challenges, we still see sufficient rating headroom in our rated banks' standalone credit profile as expressed by their viability rating under bank criteria.
Great. Thanks very much for that very comprehensive overview of the sector. I want to turn now to discussing some of the specific, I suppose, challenges facing Chinese banks. Over the past several years, the property sector correction has been quite a dominant story in China. I guess, has this ongoing property adjustment, has it had any significant implications for the banking sector?
This certainly has. The continued property sector stress has definitely contributed to our sector outlook for Chinese banks, which we put at deteriorating this year. While the government has introduced a lot of support measures for property sector, these measures tend to have a negative impact on bank profit in general. For example, the removal of the minimum mortgage rate floor and interest rate reduction we just mentioned, and the prolonged property stress also drag on the overall loan demand and impairments, especially for small regional banks which operate in weaker regions. We expect further performance divergence among large and small regional banks in coming years. The negative impact on asset quality is not going to be uniform across the board. Our rated banks are generally better positioned to withstand the asset quality deterioration. This is supported by their manageable exposure to developers, which average around 4% of their total loans. Our rated banks also tend to have modest loan-to-value ratio for their residential mortgage. So the average LTV for mortgage was around 60%. Those policy measures introduced so far have also helped to mitigate further development loan deteriorating, with NPL ratio declined modestly to 4.3% by the end of first half from 4.6% by the end of last year, while NPL ratio for residential mortgage remained very low at only 0.6% by the end of first half of this year.
Thanks. And you mentioned about the government's policy response, and more recently, part of the policy response has been focused on the banking sector. So we've seen measures to encourage bank lending to property projects on the so-called whitelist. Seen a RMB 300 billion facility that was announced to finance SOE purchases of empty housing projects. Are banks actively participating in these facilities that the government has rolled out?
That's right, Jeremy. The authority have introduced new property support measures to help restore the housing demand, also trying to address issues around unsold inventories. We have seen a modest pickup in property development loan during first half at some banks, and we understand most of the underlying projects are located in top-tier cities and so has a high level of collaterals. In addition, majority of those projects being financed are still extended to top-tier SOE developer according to banks. And for mortgage, most new mortgages are concentrated in Tier 1 and Tier 2 cities, and we do not expect a sharp increase in the overall LTV ratio despite the relaxation in the down payment requirement. You also mentioned the 300 billion PBOC re-lending program. Overall scale is quite small compared to the large stock of unsold new homes. Banks remain very selective when financing new property development projects and trying to prioritize commercially feasible projects, those with sufficient rental yields to cover interest repayment and other operating costs.
Switching gears a little bit, during the China Perspectives podcast last month, our team that focuses on local government entities highlighted that authorities are looking to reduce LGFV debt risks by essentially optimizing their financing situation, and that renegotiation of bank loans are kind of a core part of this process. What does this mean for the banking sector? How exposed are banks to LGFVs, and what has this debt renegotiation process looked like thus far?
Right, and Chinese banks are directly exposed to LGFV through loans and bonds. They also indirectly exposed through interest investment and those off-balance sheet WMPs. We estimate the LGFV exposure for Fitch-rated Chinese commercial banks could be up to 15% of their total assets on average. Although our estimate could be overstated because the calculation also includes loans to non-LGFV local SOEs. So the authorities have adopted a mix of policy tools trying to tackle the risk around LGFVs, among which we view bank loan renegotiation as one of the most important ones, because banks are usually the largest creditor to LGFVs. Now, loan renegotiation usually involves maturity extension and interest rate reduction. It is crucial to balance this against the bank profitability because ensuring reasonable bank profits in general is also a very important regulatory target trying to preserve the general financial stability.
And building on that a bit, how does Fitch see the likely impact of these debt renegotiations on banks' financial profiles? And does this, in our view, contribute to any broad concerns for the banking sector and financial stability?
We've actually run a couple of scenario analysis trying to assess the potential impact. So for our rated banks, from our estimate, they can generally withstand up to 5% of LGFV loans going through renegotiation in next 1 to 2 years without a material impact to their current viability rating. But under a much more severe scenario, 15% of LGFV loan renegotiated, which is a bit similar to PBOC's severe stress assumption, there could be multiple notches of downgrade in banks' profitability also for their capital score. And this could also test the overall resilience of the banking sector and our assessment of China's operating environment score, which currently we scored at BBB- with a stable outlook. Now, on the other hand, small regional Chinese banks, especially those in weaker regions, are facing much higher debt service burden and much more vulnerable to rising LGFV debt risk because of their narrow geography focus and also very deeply involved to support those local troubled LGFVs.
So as you just said, some of these smaller local and regional banks have come under a bit of strain recently. So how have the authorities been managing those challenges at those smaller banks? Are there any risks of contagion from the stress that we're seeing kind of in that segment?
The authorities have introduced a lot of tools to resolve small bank risk in past few years. The most common approach has been consolidation. Around 70 small banks were merged from 2019 to 2023, comparing to only a handful from 2014 to 2018. So majority of them are rural banks from mid or northeastern part of China. Further consolidation will be helpful to ease the regulatory oversight burden, allow the regulator to better focus the resources, and also trying to tackle issues around internal control and the governance of smaller banks. Now, this could also be helpful to segregate risk from small bank failure. Financial institutions labeled by the PBOC as high risk, less than 2% of the banking sector assets, and the regulatory measures to reduce systematic risk, such as the establishment of the financial stability law, have also helped to mitigate potential system contagion risk.
So from our discussion so far, it seems very clear that banks are being asked to play an increasing role in policy support in the economy, particularly when it comes to the property sector and managing some of those risks from LGFVs. Do banks, in our view, still have the ability to take on this increased policy role while still being able to play their traditional role of allocating credit in the economy, particularly as the government is seeking to ramp up its investments in new advanced industries?
That's a good question. So, in our base case scenario, we expect commercial banks to balance commercial and non-commercial priorities when they are carrying out their policy and quasi-policy function. We do not expect Chinese authority to rely excessively on commercial banks to support troubled developer or LGFVs, as this could really undermine regulatory efforts to preserve the general financial system stability over the past decade.
Great. Thank you, Elaine, for joining us today and giving us the lay of the land for the banking sector in China, and particularly how the sector is adapting to and managing its greater role in policy support. This has been a very useful discussion, and I would encourage all of our listeners to take a look at some of the research from Elaine's team and keep an eye out for some of the excellent research that is yet to come from the banking team on these and other banking sector-related topics. You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. And please subscribe to China Perspectives on iTunes, Spotify, or wherever you get your podcast. Thank you for listening, and take care until next time.